Well, I think a lot of the sort of core structural dynamics that were persistent over the course of the sort of 40 years before COVID that drove disinflationary pressures are mostly gone. And you touch on a few of them. We basically went from a period of not particularly well globally integrated to very globally integrated, and China entering the WTO being a big part of that. We went from a period where we had a billion people working on the farm, and now they have moved into the factory, and that's massively increased, across Asia, and that's massively increased their productive capacity. We had a period, I think probably doesn't get talked about enough, of an unusual period of peace globally. If you looked at, for instance, the amount of the loss of life in global conflicts over the course of the previous 40 years before the Russia-Ukraine conflict, it was basically at 1,000-year lows. And so that's the sort of thing that you wouldn't necessarily expect to persist. And I think that there's certainly indications that it is not going to persist on a forward-looking basis. And war is inflationary structurally. Peace is disinflationary. War is inflationary, both because of the destruction of material involved with it, but also because it creates a pullback of globalization, trade, all the big disinflationary pressures that exist. And I think more structurally, a lot of the deep-seated disinflationary forces that existed in the U.S. economy that really created that risk of deflation in the post-GFC period have mostly been resolved, in the sense of, household balance sheets are in fantastic shape. 15 years ago, they were in terrible shape. Business balance sheets are in great, generally in great shape, particularly big business balance sheets are in great shape. They were in real trouble 15 years ago. And so that confluence of things, deglobalization, increased conflict, the resolution essentially of the deleveraging dynamic and the debt overhang in the post-GFC period, all of that points to higher inflation ahead rather than lower inflation ahead relative to what we experienced pre-COVID. I think the main question, I should say, is the Fed basically has one tool to resolve that issue, which is to constrain domestic nominal demand. So if we're in a period where where inflationary pressures are persistent, then the question is, do they respond to that by reducing domestic nominal demand in order to contain inflation, or do they choose not to respond to that and essentially allow inflation to run hot for an extended period of time? That's a big question that has yet to be resolved. And I think, each day we sort of incrementally learn a bit of information about it. But I think that's the real outstanding question, because if we're in an environment where not only do we have those higher inflationary pressures, but the Fed is accommodating to those higher inflationary pressures, that's going to be a very different long-term macroeconomic environment than we've seen in the last couple of decades.
I couldn't agree more with that last comment. That's the big question still. The Fed has yet to come out and say they're okay with that. I don't know that they ever will, just because, whether they believe that or not, just because if they do, then they lose control of the long end of the curve, and that makes inflation worse, right? So I think a lot of when we hear, we're now on transitory 3.0, I think is what I call it. Like, they keep saying, inflation is transitory. But the reason they do that is not because I actually think they think it's transitory. It's because they want to try and convince the market that it could be. And so they keep the longer end of the curve down. And at some point, I think the market doesn't keep falling for that trick, right? And that's what we saw in the 70s. The market kind of was like, okay, we believe you, you can control inflation, until they couldn't. And then it just took off, right? So, again, remains to be seen, but I agree with your points. And I think we broadly agree that there's a structural element to this inflation, and that is trying to be controlled cyclically, and that they can control it short-term cyclically. We can look at CPI coming down, but they have a stagflationary issue at the end of the day. They're dealing with inflation and the economy slowing at the same time. And at some point they'll have to choose. Whereas for 40 years, they basically didn't, because they were in a structurally deflationary period. And that's a big deal. So What works in that environment? What are we? I know you're big on commodities and gold. Talk to me a little bit about what you see asset allocation, kind of how it should look in the years ahead.
I think the outstanding question, for what it's worth, whether or not they actually are going to give up or are giving up on the inflation mandate at 2%. I think there's a lot of folks who think that, you sort of casually say, well, they're political, so they're just trying to stimulate the economy, or, they're just giving up on it. I'm not sure that that's right with this composition, this Fed composition. When I look at how they're behaving, which is, to be clear, they've said lots of times they're going to cut and have done nothing for the last, 9 months. And likely, we'll see if they do nothing, if inflation remains where it is today. And you look at their commentary about trying to understand what's going on, it looks more like they don't understand what's going on and are too concerned about a credit style cycle rather than, and that would hit growth. They look more concerned about that than they do about being sort of okay with inflation being where it is.